Understanding the difference between defined benefit (DB) and defined contribution (DC) pensions is essential for Canadian workers. This guide walks you through both plan types, the commuted value decision, and how to choose the option that aligns with your circumstances. Here's what we'll cover: what is a defined benefit pension, the commuted value decision, and what is a defined contribution pension. Stick around, the strategies in here add up to real money. What is a defined benefit pension? A defined benefit (DB) pension guarantees you a specific monthly payment for life, calculated using a formula set by your employer. The DB formula. Most DB plans use a simple formula: pension equals 2% times average best salary times years of service. Here's a concrete example. Michael worked for a bank for 30 years, retiring in 2026. His average salary over his 5 highest earning years, used for pension calculation, was $90,000. Using the 2% formula, 2% times $90,000 times 30 years equals $54,000 per year. Michael will receive $4,500 per month, $54,000 divided by 12, for the rest of his life, indexed annually for inflation. If he lives to 95, that's roughly $1.62 million in total payments, all guaranteed by the employer's pension plan. Key features of DB pensions. Guaranteed income: the monthly amount is locked in and doesn't fluctuate with market performance. This is profound peace of mind, you know exactly what you'll receive. Longevity insurance: if you live to 100, you still receive your full benefit. DB pensions are the closest private sector equivalent to CPP or OAS, they protect you against outliving your money. Inflation indexing: most DB plans include automatic annual increases tied to inflation, protecting your purchasing power in retirement. Some plans cap indexing at 2% or tie it to CPI with adjustments. DB plans and CPP integration. Some DB plans include a bridge benefit or use CPP integration to coordinate with your CPP benefit. The idea: your DB pension plus CPP should total a reasonable replacement of your final salary. A bridge benefit is an extra payment between retirement and age 65, when CPP typically starts, to bridge the gap. Once CPP begins, the bridge ends, and your DB pension adjusts downward slightly. This smooths income across the retirement transition. The commuted value decision. When you retire from a DB plan, you typically have a choice: take the guaranteed monthly pension for life, or take a one-time lump sum called the commuted value, CV. The CV decision framework. Choosing between a DB pension and a commuted value lump sum requires honest answers to these questions. The break-even analysis for commuted value. Here's a critical calculation: at what age does your lifetime pension total exceed the lump sum you could have taken? Michael, from our earlier example, faces this choice at retirement age 65. If Michael takes the lump sum and invests it conservatively at 4% annually, he'd generate roughly $31,200 per year in the first year, before inflation. To match the pension's $54,000, he'd need to generate $54,000 from $780,000, roughly a 6.9% annual return, which requires more stock exposure and risk. Here are the key insights to take away. How is your health? If you have a serious health condition or family history of early mortality, the lump sum might be better. You won't live long enough to break even on the pension, so taking a lump sum and leaving it to your estate matters more. What's your life expectancy? If you're in excellent health with strong family longevity, a DB pension is gold, guaranteed income for decades. Are you comfortable managing investments? A lump sum requires you to invest it, likely in a LIRA or self-directed account, and manage risk. If investment management stresses you out, a pension's simplicity is valuable. What are your other income sources? If you have CPP, OAS, and other pension income already, you might not need the DB pension for essential expenses. A lump sum gives you flexibility for goals like travel or leaving an inheritance. A few more to keep in mind. What are current interest rates? CV calculations assume interest rate expectations. In a low-rate environment, the CV is artificially high. In a high-rate environment, the CV is lower. This matters. A $780,000 CV today might be worth $650,000 next year if rates rise. Do you have dependents? If you're young with family obligations, you might prefer a lump sum to ensure your family is protected, with life insurance, and leave flexibility for their education or needs. If you're older and single, a pension's simplicity wins. What is a defined contribution pension? A defined contribution (DC) pension flips the risk entirely onto the employee. How DC plans work? A typical DC plan works like this: employer contribution. Employer commits to contributing a fixed percentage of salary, e.g., 5%, to your account annually. Employee contribution. You contribute a percentage as well, often matching the employer or separately defined. Investment choice. You direct contributions into investment options, a menu of mutual funds, ETFs, or other securities. Growth. Your account grows, or shrinks, based on investment performance. Retirement income. At retirement, you have a lump sum. You must convert it to retirement income via annuity purchase, LIRA, locked-in retirement account, LIF, life income fund, or other options. Key features of DC pensions. Employer contribution is defined, not the benefit. The only certainty is the employer's annual contribution. Everything beyond that is uncertain. Investment risk rests on you. You choose how aggressively to invest. Too conservative, and inflation erodes returns. Too aggressive, and market downturns hit hard near retirement. Flexibility. At retirement, you can take a lump sum, subject to locked-in rules, purchase an annuity, or use a LIF to generate income. You have options. Estate value. If you die before retirement, your account balance passes to your heirs, or estate. This contrasts with a DB pension where a lump sum death benefit is much smaller. Locked-in rules vary by province. In most provinces, DC pensions, and LIRAs, are subject to locked-in rules. You can't withdraw the funds before retirement. The rules protect retirement savings but limit flexibility. Some provinces, like Ontario, allow a home buyer's planned withdrawal from a locked-in account to purchase a principal residence. Others allow withdrawals if you're in financial hardship. But generally, DC pension money is locked until your 50s or early 60s, depending on province. These rules create a timing mismatch. You might need cash at 55, but your locked-in DC account isn't accessible until 60. Plan accordingly. Here are the key insights to take away. Employer contribution. Employer commits to contributing a fixed percentage of salary, e.g., 5%, to your account annually. Employee contribution. You contribute a percentage as well, often matching the employer or separately defined. Investment choice. You direct contributions into investment options, a menu of mutual funds, ETFs, or other securities. Growth. Your account grows, or shrinks, based on investment performance. A few more to keep in mind. Retirement income. At retirement, you have a lump sum. You must convert it to retirement income via annuity purchase, LIRA, locked-in retirement account, LIF, life income fund, or other options. DB versus DC, side-by-side comparison. Benefit amount. Defined benefit, DB guaranteed, formula-based. Defined contribution, DC depends on contributions plus investment performance. The table also covers investment risk, longevity risk, and inflation protection. Check the row that fits your situation. Group RRSPs, DPSPs, and PRPPs. Beyond DB and DC pensions, Canadian employers offer other retirement savings vehicles. Here's how Group RRSP, DPSP, and PRPP compare. Employer contributions. Group RRSP, fixed or variable percentage. DPSP, tied to company profits. PRPP, fixed percentage. The table also covers employee contributions, investment control, and portability. Check the row that fits your situation. Critical questions to ask your employer before retiring. Before making any pension decision, gather information from your HR or pension department. Here's the order. What's the exact pension formula? Get the 2% figure, understand CPP integration, and clarify average best salary, usually best 5 years, sometimes best 3. Am I eligible for unreduced, early retirement? Some plans let you retire at 55 with no reduction if you have 30 years of service. Others reduce benefits if you're under 65. Know your threshold. What's the commuted value? If you're considering a lump sum, request a formal CV calculation from the plan administrator. Are benefits indexed? If so, is indexing automatic at 100% of inflation, capped at 2%, or tied to plan funding? This significantly affects long-term value. What survivor benefits am I entitled to? If you die, what does your spouse receive? Are there guarantees, e.g., guaranteed 10-year payments to estate? Are there any bridging benefits? Does the plan include a bridge payment until CPP begins, and how much will it adjust downward when CPP kicks in? What are the rules for leaving this employer? If you're considering a job change, what happens to your benefits? Are they vested immediately, or do you need to stay longer? Is the plan well funded? Ask if there's a funding deficit. A severely underfunded plan is riskier, though the PBGF, Pension Benefits Guarantee Fund, provides some protection. If considering a lump sum, what's the interest rate assumption? The rate used to calculate commuted value directly affects the CV amount. Lower rates equals higher CV. If rates are about to rise, a higher CV now is valuable. Continuing, are benefits indexed? What survivor benefits am I entitled to? Are there any bridging benefits? Continuing, what are the rules for leaving this employer? Is the plan well funded? Ask if there's a funding deficit. A severely underfunded plan is riskier, though the PBGF, Pension Benefits Guarantee Fund, provides some protection. The role of the Pension Benefits Guarantee Fund. If your employer goes bankrupt and the DB pension plan is underfunded, you're not left hanging entirely. The Pension Benefits Guarantee Fund, PBGF, a federal crown corporation, protects eligible members. The PBGF covers up to a maximum monthly benefit, indexed, roughly $1,500 to $2,000 per month in 2026, depending on retirement age, if your plan can't pay. This is substantial protection but not a dollar-for-dollar guarantee. High earners with large pensions might not receive their full amount. Understanding PBGF coverage gives comfort. A DB pension with an employer of modest financial strength is still relatively safe thanks to this backstop. Making the decision. If you're facing the commuted value decision, use this checklist. Here's the order. You're in excellent health and expect to live past 85. You're uncomfortable managing investments. You value guaranteed income and don't need large sums for specific goals. You want simplicity, a fixed payment from the employer, not market risk. You have dependents who benefit from your longevity insurance. Here's the order. You have serious health concerns and don't expect to live past 80. You're confident in your investment ability and market timing. You have specific financial goals, major travel, gifting to heirs, real estate, that need a lump sum. You want control and flexibility over your retirement income. You're young enough to manage the account over 30+ years. Current interest rates are unusually high, making CV calculations very favorable. Continuing, you want simplicity, a fixed payment from the employer, not market risk. You have dependents who benefit from your longevity insurance. DC plans and retirement income conversion. If you have a DC pension, or group RRSP/DPSP, at retirement you must convert your balance into income. Annuity purchase. Buy a life annuity from an insurance company. You give them your lump sum, and they guarantee you income for life. This is the DC equivalent of a DB pension. You've essentially converted accumulated capital into guaranteed income. Annuities are expensive, insurance companies take a cut, and inflexible, but they eliminate longevity risk. If you live to 100, you're covered. However, if you die at 72, your heirs receive nothing, unless you've chosen a guaranteed period, say 10 years. LIRA, Locked-in Retirement Account. A LIRA lets you invest your locked-in DC balance in a personal account. You control investments, but you can't withdraw the money. Locked-in rules apply. At a later age, typically 55 to 60, you must convert the lira to a LIF or annuity. LIF, Life Income Fund. A LIF is a registered account similar to a RRIF where you invest your locked-in balance and withdraw income annually. LIFs have minimum and maximum withdrawal limits set by regulation, protecting you from spending too much early. A LIF provides more flexibility than an annuity but less certainty. You manage investments. If markets crash, your account shrinks and withdrawal capacity drops. Lump sum withdrawal, in some provinces. Some provinces allow full unlocking of DC balances under certain circumstances: age, financial hardship, low balance. If you qualify, you can take the full amount and manage it yourself. This offers maximum flexibility but maximum risk. Action steps before your pension decision. If you're approaching retirement with a DB or DC pension, here's the order. Request detailed plan documents from your HR department. Read the member's booklet, not just a summary. Get a formal benefit statement showing your projected pension amount at various retirement ages, indexed projections, and survivor benefit details. If considering a commuted value, get a formal CV calculation. The amount depends on interest rate assumptions, so understand what rates were used. Consult a fee-only financial planner or actuary if the numbers are large. A $500 to $1,000 professional consultation could be worth tens of thousands of dollars in better decision-making. Model the decision against your other retirement income sources: CPP, OAS, investment accounts, and other pensions. How does each option change your overall retirement picture? Run what-if scenarios. What if you live to 90? What if markets drop 30% in year 2 of your retirement? How does each choice handle these scenarios? Consider your health and longevity realistically. A DB pension's value is directly tied to how long you'll live. Be honest with yourself, don't rush. Most employers allow 30 to 90 days to make the decision. Use the time to think and consult advisors. The DB versus DC decision, and the commuted value choice within DB plans, are among the most consequential financial decisions of your life. They deserve serious attention, professional input, and honest self-assessment. A DB pension is a gift many Canadians don't have. If you have one, the financial security it provides is worth real money. Don't trade it lightly for a lump sum unless your circumstances strongly favor the choice. Get the details right, and your retirement is on much firmer ground. Ready to build your complete retirement plan? Download the Canadian Retirement Guide, our free 71-page ebook covering everything from CPP optimization to estate planning. Continuing, consult a fee-only financial planner or actuary if the numbers are large. Model the decision against your other retirement income sources: CPP, OAS, investment accounts, and other pensions. Run what-if scenarios. What if you live to 90? Continuing, consider your health and longevity realistically. Don't rush. You've got the playbook. Keep optimizing.